Kyle, very good to see you. I want to record today on recent market volatility because, of course, a lot of people have been feeling anxious. Concerns about a cooling U.S. economy led to a market rout recently, with the Dow down as many as 1,100 points in early trading. Stocks and treasury yields paired some declines after service sector data came back better than expected. So, of course, volatility and corrections are to be expected, but I want to show you one more quick visual here. This is a chart from FinViz, which shows the S&P 500, and this is the 1 week performance. Of course, last week there was a lot more red on the board, but what should we keep in mind during volatile moments like this?
Absolutely. Great to be with you here, Erin. Monday was a really crazy day this week. If you remember the COVID crash back in 2020, Monday of this week was just as, if not more volatile. I mean, there was more fear in markets than there was during the COVID crash. And we sent a lot of this out in an email to our clients, but there were three big things that happened that were all earnings driven. And I'm a firm believer that markets are driven on earnings at the end of the day.
Mm-hmm.
The first thing was Japan's stock market had a huge drop. I mean, about 12 to 18% somewhere midday, the Nikkei 225 had dropped. And that was because there was something going on called a yen carry trade, where investors were borrowing the Japanese yen at near zero rates and then investing that in U.S. securities. Our rates are near 5.25%, 5.5%. So it's an excellent deal for investors. But recently, Japan started raising those rates up from zero. And that's resetting prices in the markets globally. That was number one. Number two, there was an unemployment reading of 4.3%. This is getting outside of the Federal Reserve's comfort zone. What does that mean? That means that at some point, we've got to change our interest rates. How is that going to impact economies? And then the third thing, and this is the biggest one to me, was Intel reported its earnings recently. And the big message there was AI was not as profitable as they had hoped in their business. And that was what really spooked investors. Because AI is what's driven a lot of the market. You know, NVIDIA's had a huge year.
Absolutely.
And it was almost a perfect storm to really rattle investors. But a lot of it was earnings driven and expectations driven more than anything.
I'm glad you brought up Intel because, of course, the tech sector has done very well recently. But you and I have talked before about concentration risk. So the S&P 500 is actually being moved by 10 stocks. And this is what's known as concentration risk. So do you think that's a little bit of what we were seeing?
That absolutely. It's been a big part of what we've been seeing. If you watch the markets really closely, you'll see that here in recent times, especially over the last couple months, is the Federal Reserve has now started to entertain the idea of actually cutting rates in their language. There's been a little bit of a rotation happening in markets away from these big tech names, AI names, and into more traditional value-based stocks. So one of the big moves that we've made in some of our portfolios is moving to more of an equal weight stance in the S&P 500. So not all S&P 500 ETFs are structured the same. Like you said, if you have a general index fund, you're not invested in 500 companies evenly. You're invested in the current setup, and it was incredibly saturated.
Right. So, of course, Kyle, we need to remind everybody watching, when we see the S&P, take a dive, the S&P 500 is not a well-diversified portfolio. So how did a well-diversified portfolio stand up to recent market volatility?
That's a really good point, because there was one other observation that we had on Monday of this week, and it was that bonds were actually up.
Right.
Believe it or not, in the last 3 or 4 years, we have not been able to say that bonds have come up when stocks are down and vice versa. They've been moving in the same direction for the last few years, and it's been really disorienting for investors. And it's starting to move back towards the longer term narrative that bonds and stocks have a negative correlation, meaning they move in different directions. This, to me, was a positive sign for markets in light of the volatility that was happening. And in that case, obviously, diversification was a saving grace for those investors that did have a balanced portfolio as opposed to all in stocks.
Right. So just to I love this little nugget, Kyle. On Friday, I plugged into Google should I? And the first option in my drop down was sell my stocks right now. So clearly people are feeling anxious. Again, what do we keep in mind when we see these headlines?
You have to keep in mind that corrections happen and they're healthy for markets. It's a rotation that generally happens. I believe firmly in the saying that markets correct themselves in either price or in time. And you have got to stay balanced. You've got to stay disciplined. If you're Googling, should I sell my stocks right now? It's probably because you own the wrong stuff for your portfolio and it's not appropriate for your situation.
Well, you probably don't have a plan. If you are Googling, what should I be doing today? That means you do not have a plan.
Yeah, absolutely. That is correct. Having a plan gives you the peace of mind. That's our job. We help put plans together for clients. So yes, I absolutely agree.
Right. So that we're not making those knee-jerk decisions, emotional decisions. Kyle, if somebody would like to speak to you about creating a long-term financial plan and making sure they are in a well-diversified portfolio, how can they reach you?
Best way is through our website. That's firstcoastfinancialgroup.com.
All right. Kyle, thanks for your time today.
Thank you, Erin.